the shot.
This is in the shot too. Was this in the shot the whole time?
No. No, I moved the camera.
Oh, true. Are we live? Hang on. I think we're live now. Someone tell me if we're live, guys.
Yep.
We're live now. Yeah, we are. Someone tell me if we're live. Guys. We're live. I can hear myself, and that's weird. Turn that off. It's screwing with my brain. Hey, guys. Welcome on to the live Wise Wealth Show. I can see that curtain. What curtain can they see? Is there a secret curtain? What's behind the veil? Hey, Gabriel Rangel, financial investor. I see you on there. Angie Ferns, first one. Hey, everyone says they're the first one. That's good. Angie's tied in first with financial investor, and I think Gabriel actually made the first contact. I can see that curtain. Oh, so what you're seeing was the light kit boxes on the side of the camera there. That's what you were watching. Fankin, how you doing? Good to see you guys on. Welcome to the Wise Wealth Show. Episode, someone tell me, I think we're 45?
Around there.
We're getting close to a year now doing the Wise Wealth Show, so that's kind of cool. My first ever live stream was me literally standing there with my camera saying, should I build a big multi-million-dollar business? And today we've got like 13 or 14 people on our team, and it's become something massive. It hasn't even been a year yet. We've got 50 plus properties in London, Ontario. That's crazy. Showing you guys that anything is possible. I went from having 3 rental properties plus my personal residence when I started this YouTube channel. Now we have like 50 plus buildings in London, Ontario. That's in a year. And I'm no one special. I'm nothing special. I've just been applying prudence and diligence and a lot of what I've learned over the last 7 years actively each and every day. So yeah. Thanking. Do I day trade? No, you're gonna love my video coming out in the next 2 weeks though on specifically, I'm gonna be doing a video on the 20-year annualized returns of every single asset class. So like small cap, large cap, all the different types of asset classes. I was supposed to talk about cryptocurrency, but I forgot because we were running late on the Wise Wealth Show. But yeah, no, I don't day trade. I did day trade. I have day traded in the past. What my overall returns have been from day trading were about like 6 or 7%. Not very good, to be honest with you. I think 6 or 7% is super low. Some people will be happy with that, but for the amount of time it takes and the stress associated with day trading, when you're making a big day trade, and even if you're buying on margin, where you're buying more than the cash position you have, so you can lever up and buy a little bit of stock and stuff like that with day trading, you gotta be very, very careful, especially if you're options trading, because the downside can be huge. I'd be up 20% and I would be down like 20%. And the highs and lows are very painful. Real estate is stable, you're in full control. When you're day trading, you don't have that full control in this to the same extent. With real estate, it literally, like, unless I screw up really badly, I get a 20% annualized return. Even if I have like a month or two of vacancy and like a tenant destroys a unit, a few $1,000s will often fix all of those problems. And then I'll have a ton of cash flow for the rest of the year. And I've built enough margin in that we make a return that is much higher, even before I had all those things happening, than I would have got buying public equity. That's public equities are great because there's no effort, there's no management. I gotta manage my properties, I gotta manage all the renovation crews. We are like swamped to my eyeballs right now. We have 25 units to rent in London, Ontario right now. A bunch of units came available all at the same time, a bunch of properties closed, and a bunch are finishing renovation all at the exact same time, all that need to be rented out from May 1st. A bunch of them are student properties. So if you miss the boat, September 1st is your next big window for students. You might have to put them in by the bedroom for the summer, or there's different, you might have to put a family in, that kind of thing. So it can be very challenging at this time of year. And we're swamped with that. And we got way too many renovations going. It is like burnout city up in here. And I'm craving that early retirement lifestyle again. So I think we're gonna tone it down a little bit in the next few weeks. That's the reflection going on the last year of, I guess we started the business in June or July. So coming up on a year, we're gonna see how much growth we've had. We've become, we're well over a 7-figure valuation in this year. So we've built a pretty massive company really, really quick. It takes a lot of people many years to build companies that size. So pretty crazy overall, but I'm really excited for that video dropping in the next couple weeks. I have a bunch of good videos lined up. The Canadian real estate market video is coming out. It's gonna be a really good one. Talking about just like overall statistics and trends for the Canadian real estate market. There's gonna be another video followed by how to get your spouse or significant other on board with the FIRE journey. That's a really good video. I think a lot of people are gonna get value from that. It's been requested by a lot of you guys. And there's also one on, like I said, coming up on the annualized returns over 15 and 20 year by asset class. So everything from the S&P 500 type returns for large cap to high grade, high yield bonds, that kind of stuff. So a whole, mixed bag, and talking about real estate investments as well within that asset class. Oh, some good questions here. So financial investor says, I'm going out Saturday to look at my next possible buys. Have 5 on my list right now and talk to the local PM to see if they have any off-market ones to look at while I'm out there. Very cool. Very cool. Which market are you going to be looking? London, Ontario, Windsor? Let me know what's up, what market you're investing in. Kind of curious. But that's very interesting. 5 on your list is pretty awesome. I've found right now, as a realtor in the market, that there's just not been a ton of good supply. A lot of the MLS stuff has been going way over ask, especially in London, Ontario here. There hasn't been a really good supply of quality properties. There's been a lot of investors that have bidding prices up, and there's just not been much that I've seen. All of our deals except for one, all this year have been off market. So wholesale, private deals, not on the MLS. So kind of interesting when things slow down. I'm really excited for that slowdown that's going to happen at some point. The investor pool is going to kind of dwindle a little bit, or people are going to go on vacation, or something's going to happen. There's going to be a bit of a slowdown. I can get a few more deals. We're also kind of up to our eyeballs getting caught up on stuff. So at the same time, I'm not necessarily feeling bad about the sort of booming market that's happening in London, Ontario, because all of our properties are appreciating in that. Yeah, 67% a day. No, technically there were days where I made 10% in one day. Like back then I was trading with like $30,000 or $40,000. So 10% on that is like $400 in a day. There'd be days where I'd be up $400 or $500, a couple grand, even in a day I've been up before. But there are days where you lose a couple thousand as well. And so if you net those out over a whole year, what you find is they get 6 to 7% return. There has been over a 25-year period. So if you plan to be a day trader your whole life, over a 25-year period, what you will find is through, like, we've had a bull market the last 10 years. So every day trader you talk to out there who's trading, they're trading in a good market. So it's no matter what, you're okay. But in a recession, you start day trading and you really start losing because all the positions are down, right? And what you end up finding is over a 25-year period, no investor, except for Warren Buffett and like a handful of investors, have ever outperformed the benchmark net of fees. So if you value your time, none have ever outperformed the index. I'll say it again, the S&P 500 being one benchmark, 8% roughly type returns. No investor ever, over a 25 or 30-year period, no fund, I don't think there's a hedge, there's maybe like a 1% of hedge funds, like 1% of mutual funds, 99% of them, the guys who work on Wall Street and Bay Street, who do this for a living, who have master's degrees in finance, these guys are smart people. These guys don't outperform the index over a long period of time. They just don't. So that tells me you should just buy the index. That's why I stopped day trading, because the energy and effort and stress and anxiety, all those things associated with day trading, as cool as it is, as cool as it sounds, you're actually getting a better return probably by just buying the S&P 500 type index and holding. And over 6 years, you just double your money. You'll be better off than if you're day trading. Unless you get on a big upswing as a day trader and then you stop day trading. That's the way to win. But if you consistently plan to day trade over your whole life, you won't outperform the index. I mean, unless you're Warren Buffett, like he's like the only exception. And that's because he operates like private equity. He buys stuff strategically and then goes in there and manages them. As a day trader, you don't control management. You're trying to buy based on like trend analysis and none of that stuff works. There's no model guys claim they have these day trading models that can't be beat, blah, blah, blah. They break every year or two and then another model comes out, right? The problem is human psychology. There's a lot of DIY investors, and human psychology is such that people are irrational. How do you trade on irrational behavior? In real estate, I can exploit the hell out of it. I can buy from people who are irrational. I can hire people who are irrational and arbitrage the hell out of all those types of opportunities, right? In the public markets, things are relatively efficient. If there's an arbitrage hole, everyone jumps in and seals up that hole real quick. Or else otherwise it's a risky type investment, in which case a lot of risk, you get a lot of reward. But then it's luck. And I'm not a gambler. I don't want to invest. I want to invest for cash flow. I want to invest for stable returns I can control. I don't want to invest in something that I have no control over. So that's sort of my 2 cents on it. Hey, Eric, good to see you on. Hey, Andrew Howe, good to see you on. Jake Wing, good to see you guys on. All of the regulars popping on. And yeah, I did mean over a year. I mean, over a year of investing in investing in stocks as a day trader, you should expect 6, 7, 8%. That's about the same as what you're gonna get in the market. So you're probably better off not day trading. You're probably better off just buying a good asset allocation of public equities, hold some indexes like the S&P 500, buy some ETFs, set it and forget it, get your 7% and be happy, right? Maybe you'll have a down year, maybe you have an up year, but overall you'll average 7%. Same as a day trader. They'll have up years, down years, but overall they'll average like 7%. People just aren't good at exploiting. They just can't. They just can't exploit. The market is too efficient. You need private companies. You could buy private companies and actively do something to change management or cost or revenue growth, and then you can have a real impact. But because you're buying stocks and you're betting on management, you're betting on the people that run that company. That means you're just, betting is like gambling, right? Day trading is a lot like gambling. You can make educated gambles, but at the end of the day, it's a gamble. I'd rather just invest in sound fundamentals and enjoy a safe, consistent return for no stress. Hopefully that answers your question. Okay. Financial investor says, I think he talks yearly return. Day trading is risky and all you do is fail a few times and quit. Stick to long-term investing and build real wealth. Financial investor, 100% true. Build real wealth. Stick to the consistent, stable, tried and true means of growing. If you want to actively, some people are young and they have energy or they want to contribute actively. They say that the passive method is too passive for them. They want to be more invested in their return. I would say go buy a private business. Go get an active stake in a local business. Go find some guy who's has like for a bunch of franchises. Go invest in his business and have a real impact on his business. That's how you can actually get an extraordinary return for effort. Or invest in real estate. That's another great way to do it. You can actually put your time in and get a higher return. In real estate, you put time in, you use cheap debt and leverage, and you can get 25, 30, 50% rates of return. You won't get those types of returns day trading. You just won't, without taking exorbitant amounts of risk and eventually get burned. That's my thought. All the day traders out there, if you follow them over a 20-year period, more often than not, what you're going to find is that, and most of the day traders that I talk to that are doing well, they do well because they sell courses, because they have social media presences. It's other things that keep them going. It's not necessarily the day trading. They might have like 2 good years of day trading. Like if you're day trading from like 2014 to 2019, you're like a 23-year-old, you've never had a bad year. It's been like the strongest economy ever. So even if you made a bad day trade, you could just hold it for like 6 months and be fine because the market was moving in a general direction upwards. That's a good time to be day trading. But I would argue they're just better off probably over a 25-year period just holding a collective basket of stocks that is well balanced. E. McHugh says, hello from Maine, aka south of Canada. Hello. Cassie says, hey Cassie, how you doing? Yeah, I'm still on one property, currently looking at a possibility of another. Congrats on your success over the last year. Hey, that's no problem. You know what? For me to get from my first property at 19 to my second property at 22 took me, like, look at that, 3 years. And I was actively trying to get my second property. I was saving everything to get that down payment for the second one. The thing is, it's like when you start rolling a snowball down a hill, it starts slow, right? You got to roll it. Once it's rolling and it's huge, it's like an avalanche. You can't stop it. Like with me having 50 properties, if I take my foot off the gas entirely and go on vacations all day, I'll still end up at 100 properties without trying because the rental income's all coming in. And if you can't spend it, you got down payments for properties. Like it got to a point where my Rosehart real estate snowball, where I had 10, 12, 14 properties, and I was saving a down payment for another one on like 4 months because all the rental income from the first 14. If you're generating 20% return on your properties, you need like 5 rentals to generate enough down payment for another one each every year. So your 5 rentals buy you a 6th, right? And then it just snowballs. Then you have 6 cash flowing, helps you get a next one in 10 months, then 8 months, 6 months. So it gets faster. It's actually really hard to get your first million, I think. It's actually really hard to get your first property, your second property, your third property. It gets a lot easier when you get to your 5th and 6th. I think there are walls and hurdles you're going to hit along the way, but as you start to build up that wealth and your spending stays relatively flat, let's say, it just gets so easy to accumulate wealth. And so take comfort in knowing that it took even some of the most advanced investors, I'm not saying I'm the most advanced, there are people who are way more advanced than I am, but it took me a long time to go from 1 to 2 properties. It took me as long to go from 1 to 2 properties as it did to go from 10 to 50. You know what I mean? So just goes to show. I'm a local in the US, Oregon. Right on. So yeah, you have to share what the cap rates are like in Oregon. I hear some good things in the Midwest and different areas of the US where they have some really good cap rates, really attractive return on investment. Hi Mike, what strategies do you recommend when learning the real estate market in London? Andrew Howe, good question. I talk about this all the time, but One of them is just going out and seeing properties in the local market, going to networking events and talking to people, talk to agents in town, look at some demographics for the city. Overall, unemployment rate right now in London is 4.8%. In Toronto, it's 7%. So London's economy is actually stronger than Toronto right now from an unemployment rate perspective. Income to house price, better in London than Toronto. Way better than in Vancouver, right? Like the income of the average family to the house price. Our economy is very diverse. There have been a ton of new jobs created in the tech sector, in the service-based economy. So like everything like accounting, all those kinds of things are service-based. There also are like fast food jobs too being created and stuff like that to service the people who are working these tech jobs and these manufacturing jobs. And yeah, like London's a very diverse market. We have a ton of education, a ton of healthcare, a ton of manufacturing. So that's something to know about London. Watch these shows, watch these videos, and ask the right questions. That's a good way to learn about your market too. Good question. Cassie says, same thing in North Bay. We have really low inventory and it's been lean for pickings. Yeah, low inventories have been a real problem in Canadian real estate. I would like to see the market slow down. Unfortunately, we're seeing a divide in Canada where there's people who are in Toronto and Vancouver who had houses appreciate, from 500,000 to 1.5 million. Those people all have an extra $1 million. So there's a ton of wealth. Everyone has $1 million. Like everyone I reach out to is like, oh, I got $1 million. I got $1 million. $1 million is like table stakes now if you owned a house in Toronto or Vancouver over the last 15 years, 20 years. People just have a lot of wealth right now. And the problem is all those investors are getting smart and they're going to markets like London and buying properties that cash flow really well and less cash flow really well. It's interesting in markets like Kitchener, Waterloo, and some of the surrounding markets, they don't have cash flow either. And all these guys are investing just for appreciation or arbitrage plays. That's dangerous. If we get to that point in London, I'm gonna have to move to a different market. Or I'm gonna have to change my strategy entirely to be just focused on flips. Like there will be if there's no cash flow, I can't I have nothing to offer you guys. I would just wind up that part of the business to just do flips. Buy under market properties, sell them at market, right? When cash flow dries up, there is no desire to be buying properties here. And it's happening, not yet. We still have a lot of time, I think, in London, but it is happening. And it's a good thing because all the properties that we have will have appreciated a ton when that happens. But if it happens, it kind of kills my business model because there is no cash flow anymore. I don't know how investors in Toronto do it. They Airbnb and they do like a bunch of student bedrooms. I guess that's what London will become. We'll do like 10 bedrooms in a house and crank out every room for cash flow. And yeah, it's the evolution of the market. Good question. Okay, hang on here.
Guess I better keep building my business, eh?
We can get you a vendor take back, man.
I can get another vendor take. I'd be happy with 2 properties at cash flow 1,000.
Yeah.
That'd be a good start.
That would be. You'd be safe. You'd be financially independent with that.
I'd be fine to hold that for a little while.
You would be.
Really
We need to get Kyle on the channel. Like, you guys need to encourage him in the comments to sit down with me and interview him and let me walk you guys through my old property where I used to live with the tiny house. He lives there now. And I'd like you guys to see just how well it's going for him and how you can literally house hack from one property.
We could do a walkthrough of the house because
Yeah.
it's fucking great now.
Yeah, and while we're there, I'll ask you some questions casually, and the audience can see how somebody who loves art and has no interest in like finance because a lot of people here are like, I don't understand finance, I can't buy real estate.
Yeah.
Kyle didn't understand finance either, and you can figure out how to run an Airbnb, right? You're running it. People are staying there. You're getting money.
Staying there right now.
Yeah, there you go. So he's paying the mortgage and paying all the expenses, and I think you even still have a little bit of money left over at the end of the month after living there for free. Like most people are just hoping to live for free. He's making money on top of that, so that's a win-win all around.
I just work like a dog outside of that.
You do. This is true, and I do too. Birds of a feather, Okay, financial investor says, yeah, it can be tough. I've seen the MLS pools growing, people dropping some way overpriced 2-1s on the market doing a basic rehab. No one is going to buy a flip. Yeah, I mean, definitely. There's some risk, obviously, with flipping properties. There are some inherent risks that you don't have in, oops. Okay, we're still good.
Don't cancel the stream.
No, stream's still going. Guys, you still hear me? I'm still here, I'm still live. Yeah, Jake, great question. Actually, it's on my video queue is doing a mentee video. More than a mentee video, maybe even like a promotional video on what Right Way is all about. That might be something cool. I see some really good questions here. I'm excited to get to them. Rapid fire round. That's surprising to hear. Fankin says, in BC, the volume is huge. No one's buying, no one's selling. Seeing who blinks first. Fankin, you're going to love this video I have coming up this Saturday on Canadian real estate market because I talk a bunch about Vancouver. Vancouver is like the poster boy for a looming down cycle we're going to see in real estate, I think. What ends up happening almost always is exactly what you described. So sellers are very emotional. People who buy and sell real estate, it's almost always emotional. Like 90% of real estate transactions, even investor type properties, are emotion based. It's psychological. That's why I can win this game, because it's a psychological game. You don't have that same arbitrage in the public markets. So what that means is, let's talk about that example. So you've got people who see their neighbor's house sell for $2.8 million in Vancouver. And like, my house is worth $2.8 million. I built 20 years of memories here. That is what my house is worth. And they ground it they anchor, it's called anchoring bias. They anchor on one sale they hear about. And now the market's coming down. There are a bunch of reasons why Vancouver's overpriced. 22 times average annual household income for a house in Vancouver. Overpriced is at 5 and above. So if it's 5 times household income for the average house in that area, it's over that, it's overpriced. So Vancouver is the second most expensive city in the world, second only to Hong Kong. Makes no sense. There's no cash flow there. I would never own property in Vancouver. I would always rent. You can rent these mansions for like $4 or $5 grand a month. The mortgage on that property is $10,000 a month. These people are putting stupid money into these properties, and you can just go rent them for way cheaper, especially if you're a qualified tenant. You'll be able to rent one of those properties really easily and take good care of it. I know people who are doing that. I know people who also, my business partner owns a property in Vancouver, they own a couple properties in Vancouver. I tell them every day, sell that property in Vancouver, but there's emotional reasons why they keep it, and it is what it is. But at the end of the day, what we're seeing in Vancouver, and we're seeing a lot of these markets that are starting to slow down in Canada, London not being one of them. London's the opposite of this, but in what you're seeing in these areas is there's a ton of supply. Average days on market, so how long it takes a house to sell, is growing. We're seeing houses in Vancouver taking like 30, 60, some of them even 90 days and longer to sell. Here in London, we're seeing 6 days average market. You put a house up and it's sold, on average. In Vancouver, the opposite, because the sellers are anchored to a price. They see the neighbor's house sold for 2.8. And until someone gives and sells at 2 million, they're stuck on their 2.8, and they just won't sell for like 2. So they're getting lots of lowball offers coming in. People are still wanting to buy, but they're offering like 2 million on these houses listed for 2.6. And until those people agree to strike on a price, the market won't drop. So average house price in Vancouver hasn't actually dropped near all that much because people just aren't selling. But eventually, something will happen. There'll be a bit of a recession. Interest rates could rise, job loss, whatever it is. People get nervous about the Canadian economy for whatever reason, and people start getting nervous and they start wanting to sell. Once people start selling, once that fire sale starts, once that person agrees and takes that $2 million offer, the chain reaction starts. And when you're holding in a down market, and every day you're like, tomorrow I sell it and it's a little bit less valuable, a little bit less valuable. You're like, I'm holding onto a hot potato. I gotta get rid of this house because it keeps dropping in value. That's when you get into a real recession, and the snowball has to start. It hasn't happened yet. We need a catalyst, something to start that in places like Vancouver. Toronto as well. We're seeing the same sort of thing happening right now. I'm extremely bearish on Toronto and Vancouver real estate. They make up a large portion of the Canadian real estate. So on Canadian real estate, I'm actually bearish, but London, Ontario, I'm still bullish. Other markets like Sarnia, Windsor, I am still slightly bullish. I would say I'm neutral outlook on those areas. Windsor, I'm neutral. Yeah, I would say I'm neutral on Windsor right now. I'm not bearish. I'm not bullish. I think there's been a lot of tension, a lot of heat on Windsor, and it's heated things up to a level where it's at value. I don't think there's an opportunity like there was a year ago. It's just my 2 cents. I could be wrong, I also wrote an article on my blog, a year ago or something, maybe longer than a year ago, when Bitcoin was at 20,500 or something like that price. I wrote an article and said, look, crypto's crazily overvalued. There's no cash flow here. People are literally buying crypto with the only exit of being, I'm going to sell it to someone else for more than I paid for it. No cash flow, no real value. It's just the perceived value they can sell it to someone else for more. I like the technology. I love Bitcoin technology. Actually, I don't even love Bitcoin technology that much. I like blockchain technology. I like the technology behind it, not necessarily like that one cryptocurrency. Anyway, I've been right before, but I've also been wrong before. I bet against Oldies Village here in London. And guys like Kellen and Matt McKeever, those guys cleaned up in Oldies Village. So you know what? I was walking around seeing needles on the ground and seeing druggies in alleyways, and I was like, I don't want to be around this. Like, these people are losers. I don't want to be around that. And they bet that area was going to gentrify and turn around and become a hipster area. And it did. I mean, Soho's still a terrible area. Maybe it'll gentrify too. I don't know. I bet against it. Also because my morals, I didn't want to deal with those kinds of tenants. I didn't have an interest in that. Today, I'd make those bets. But when I was looking to retire early and I was extremely conservative, I wanted to buy in really strong areas and have good tenants. I also had to manage the properties myself. I had no management team to help me. That's why I did what I did at the end of the day. Let's go back to the questions here. Oh, look at this. $10 came up from Brian Larson. Thanks for doing these streams every week, Mike. I left a comment earlier, man, but I have to head out. Hope to see you and catch you on the replay. Brian, I gotta hit your comment. It's the least I could do. Where is your comment here? Scrolling. Brian Larson, keep doing your thing, man. These courses you were talking about making a couple weeks ago would be life-changing, man. I would test run them for you. Cool. Brian, hit me a DM on Facebook or Instagram at Mike Rosehart. Instagram's a great place to slide in my DMs and ask me a question. Hopefully I didn't miss your other question there before you go. I really do appreciate the support. YouTube appreciates your support, and it helps my videos become promoted by YouTube. That's why I put ads in my videos, not because I really need the money, but because I want to make a business out of this. And I'd also like to get Kyle some money too at the end of the day. That's, we can get this channel to a point where it's actually making some money, pay back the equipment, then we can get Kyle some money for helping edit the videos and all the things that he does along the way, because he's a valued part of the team. So we do appreciate this so much. Thank you. And YouTube, again, if you look at the data, I had 12,000 views in 48 hours for a consistent period. We did 110,000 views in 28 days on YouTube. That was the best month we've ever had. That was better than like all of June to like October we did in 1 month, last month. That's how good the channel is doing now. We're at 8.3K subs. We're tracking on to 10K in the next month or so. It's becoming parabolic. We're gonna get 100K in the next like year or two. And we're gonna have videos like the Frugal Living to Retire Early videos, 69,000 something views, get almost 70,000 views. The 4% safe withdrawal rate, Secret to Retiring Early, is like almost 40,000 views. Downsides to Early Retirement, 17, 18,000 views. Every video we're dropping now is getting at least 1,000 to 2,000 views in the first day or two. And that's because you guys share it on Reddit, you guys share it on social media, you get value from the videos, you watch them all the way through, and that means a lot to me. I'm so thankful for you guys. Without you, we wouldn't have a channel. I do strongly believe in the principle that if you throw value out there to the universe and you ask for nothing in return, you will be showered in value. It's like good karma, you know what I mean? You throw value out there, you get value back. So that's huge. If I had more time, which like I have like no time right now, we're also, I can't talk too much about it, but looking at buying a business right now, a relatively large business. And to my Uncle Steve there, Steve Jensen's asked the question, how did it go? I'll answer that in just a sec. I can't talk too much because I'm under like NDA, I can't, like non-disclosure, and we've signed letters of intent and stuff like that to buy this business, so I can't share too much, but really excited about this business we're buying. What I can say is that I think there's an opportunity to 2 or 3 or 4 or 5, maybe even 10x this business and make well into the 8 figures for us. It might start us on the journey of becoming private equity in the sense that we buy businesses, improve them, turn them around, and then basically sell that business, like flip the business, or sell a portion of that business out, or go back to the bank, revalue it, and basically do a BRRRR on the business. So you can do a business BRRRR the same way you can on real estate, and you can arbitrage, retail arbitrage businesses the same way you do with real estate. It's basically what Warren Buffett did. If you read his life story in his autobiography, it's what he basically did was buy businesses and turn them around. That's how he had such great returns for so long. He wasn't day trading. He was buying physical businesses, putting new management in, and making real changes. He was controlling the stocks he's investing in. He's just doing it on a huge scale. So I'd like to get into that at some point. And I don't know how you guys can join me with that. I know a lot of you guys are investing with me on the real estate side. So hoping you guys are investing on the real estate side. If the cash flow dries up and this market continues to be such that there's no cash flow and we can't find any properties that meet the metrics because everything's overvalued, we wait for the next real estate recession. But in that time, I can buy businesses that are recession proof. Businesses that sell, you can think like medical or like food or things that people, like necessities that people need. Like no one's not gonna buy like their healthcare device that their insurance company pays for in a recession. They're gonna still need that. That's a business you can buy that's recession proof. Pest control, recession proof. Many different businesses you can buy that are recession proof, and businesses I'm looking at diversifying into. If you look at average asset classes, after 2 to 5 million net worth, there's a huge shift from the largest asset class being real estate to the largest asset class being private businesses. The net worth of people who are 5 million to 100 million, it's almost all private businesses. That's how you get to the next level. You got to be buying into businesses. And so it's the evolution of, if I continue to choose this path of growing and growing with you guys, that we start buying some businesses and do some really cool things. I'm excited to learn and to grow myself, and yeah, it's really fun. Cool. Yeah, the courses, I got to get on that. Got to do that. 100%. Gonna catch up where I was at before. Here I am. Okay, Eric, how you doing? I see you're jumping in the comments there. Jake says, have you ever bought a property from extended family? I have a potential opportunity with my partner's aunt, but my go-ahead price would be much lower than she'd like to get. It's tricky. Yeah, Jake, that's a tricky one. I almost bought a property of my own aunt, but the numbers just didn't work for us. In hindsight, I wish I would have bought it for what she sold it for, because the market has heated up and I could have made some money on it, and it still would have been a decent rental property. If we had the investor pool that I have now, I would have had one of my investors buy it. I had a limited pool of capital, but it's interesting. We have a large pool of capital. Anything over the hurdle rate of 25% return on investment, it's like an easy one. It's interesting too. Investors are very picky. I've noticed people I meet who don't know me well, right? My friends, they trust me. They like, okay, Mike, if you're in on the deal, I'm in on it with you. But people who don't know me well, they need like a lot of numbers, a lot of comfort along the way to understand what they need to do to buy the property. And maybe I should just offer I should just borrow money from people, like 10%, guaranteed rate of return, 10%, buy real estate with that, pay everyone 10%. Let's say they invest $1 million, they get $100,000 a year paid out monthly. It's like almost $10,000 a month, every single month, safe, guaranteed, backed by Canadian real estate in London, Ontario. And then maybe if there's appreciation play, I could share that as a debt option that has a sweetener. So it's 10% fixed plus a sweetener of appreciation. So they could get 50% return on their money if appreciation goes well, but the lowest they'll get is 10%. I'm thinking about creating some sort of product like that, not a product, but like just borrowing debt from people and structuring it that way. It's a lot easier than asking someone to joint venture with me. And so I'm noodling with that model. I'd be curious to hear in the comments what people think about that kind of model, and is that viable? If I just paid people like 10% guaranteed and then give them an upside of appreciation, is that more attractive to the early retirees? People who just, they're used to getting like 6% from their mutual funds net of fees. If they get 10% plus the upside of appreciation, because the appreciation could be huge. You could like double your money on appreciation, but still get that 10% safe. Makes it like it's better than a bond, like a super bond with an equity upside. So that's sort of an interesting thing I've been sort of noodling on. Sort of thinking about it. I don't even know if we'll do that or not. Okay, you short in the recession. What did I miss the? That's surprising to hear. NBC, no one's selling. So yeah, you short in a recession. It's true. You do short. So like you could go long on a bull market, buy options, or you could short options in a recession. The risky part of shorting is that oftentimes markets do like dead cat bounces, right? So there'll be a drop and there'll be a recovery. And often these options have like 30 days or 60 days, they're whatever they're expiring. And you get stuck trying to time the market. So most option traders are trying to time the market. And I do believe in the philosophy, time in the market over timing the market. So I would rather in a recession just dollar cost average. Just continue to buy the whole way down and the whole way up. Because I know long term, if you're buying at whatever price it is, in like, that flash is even showing up on camera. That's an intense flash, man.
And I'm bouncing.
I feel like I'm like a deer in headlights here.
It makes
The shots that Kyle gets though, guys, if he needs headshots down or something, hit this guy up. He has some really, really good editing quality on his pictures and takes really good pictures. This camera is like seriously massive. What was I saying though? Deer in headlights with that flash.
Honestly, I just wanted to test it. I can stop with the flash.
No, it's okay. But I am actually blind. Yeah, buying. I was talking about before. I was talking about buying from family. I got on a tangent. Buying from family is difficult. You don't want to gut your family member because they're family, so you don't want to take them for too much of a ride. Give them a fair price. At the same time, you don't want to overpay either. So just kind of be in the middle. It's not like a person you're trying to buy a deal from privately that you don't know. They're your family. So if they find out you made $100,000 on their property and you took them for a ride, that doesn't feel right. So it's kind of somewhere in the middle, I think, honestly, is where you want to be with family. Just explain very clearly what you're going to do. Like, hey, your property's worth $150,000. Well, you could say, hey, it's worth 140 to 160 on the open market based on comparables or whatever. I can afford to give you 135. I want you to give me a little bit of a discount because we're family. They might agree to that and say, that's fair. But tell them, hey, I'm going to renovate this property and then I'm going to sell it for 225 or whatever. And then if they question you after, you say, look, I added all this value in this time. That's how I made this money. And that's a fair way to do it with family. Okay, let's go back up to the question where I was at before. Shorting in a recession. Yeah, you can short in a recession, but it is risky. Even shorting in a recession, you can lose money. Believe it or not, because the dead cat balance, for instance, could cost you, your options could come due around the time the market's kind of recovered, and then it goes down again, you don't know. So options are very risky. They can be in times of recession, they're very expensive. Like when you know there's a recession already happening, it's priced in, and trying to buy those options is very, very expensive, like shorting options. Put options basically is what you'd be doing. If you're shorting the market, you'd be buying put options. Okay, good question overall though, but yeah, you're right. I like dollar cost averaging, works the same way. In times of recession, once it kicks in, real estate's always lagged a little bit, right? Like it takes like an extra 6 months to a year for real estate to catch up to to a recession. So if we have a recession, for like 6 months, market will still be hot and then eventually it'll cool down. Same is true for a big roaring market. In London, for like 6 months, there was a bull market happening and some agents that weren't very active didn't even know there was a bull market happening. They didn't even, because the data hadn't come out yet and they weren't talking to enough people. So I could still buy properties way under market for like there was a 6 month period where it was like a buying opportunity in 2017 where we just went crazy and bought like 5 properties. Worked out really well for us. I took advantage of that fact that the market's slow in real estate. It actually is killing me now, the flash kill. I actually am like, can't even read these questions. I'm sorry. It's turning me into like a deer in headlights. Okay, I could focus down the screen. Have you ever bought property from extended family? I read that question. My neighbor has had their house on market for 90 days now. Dropped their price 10K to try and sell it now. I'm seeing what he sells it at, but interested to see. Yeah, the longer, it depends on the buyer, right? If they're desperate to sell and they've been on the market 90 days, there's an opportunity there. If they aren't really desperate to sell, I've seen someone who I talked to, they've been on the market for a year and they just kept relisting it every 6 months with a new agent. And he's like, no, I'm not interested in selling. When I get my price, I'll get it. It'll take me 2 years, but I'll get it. And they eventually did. They got their like way over market price. Someone eventually paid it. But sometimes it doesn't work that way. Sometimes it gets stale and no one wants the listing. You can get in there and eventually they get desperate and they'll sell to you for a deal. So you never know. Fankin says, where did you read that stat? I'm not sure what stat you're talking about. The one about like fund managers. Yeah, you can Google it. Mutual funds underperform benchmark. Type that in. Hedge funds underperform benchmark net of fees. Type that into Google. You'll see this is why like John Bogle created the Vanguard ETF funds, exchange traded funds that had little tiny MERs, because at the end of the day, what they found was that rates of return, net of fees, lost to the index. Humans are not smarter than the aggregate of the market. People are not, after a long period of time, competitive. They just don't have a competitive advantage. VTSAX, set it and forget it. I'm thinking that you're talking about, E. McHugh is talking about like an all-in-one fund, an all-in-one ETF. Great idea. I'm a big fan of those. They're relatively easy. Set it and forget it. Get your 6-7% return. Be happy. Gabriel says it's okay to be mediocre in the stock market index investing if you can outperform in another market. Very true. Very true. Guys like Tim Sykes is a joke, isn't he? I don't know much about Tim Sykes and I can't comment. I won't be sued. I wouldn't be buying any of these day traders courses. I've seen some of the models they use and stuff like that. I'm not a huge fan. I've seen some people have extreme success for a year or two and then lose their shirts. Thanks, Dee's information, for the support on the agreeing with my day trading assessment. Financial Investors says average return for investors is 3 to 4%, whereas the S&P average is 7%. It's because those individual investors give in to fear, sell on lows, and rebuy at highs instead of holding. Yes, 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 yes. 100% Financial Investor is right. I've seen the data to support that. You are not smarter than the market. Like 98% of you guys watching, don't buy individual stocks. You are not smarter. You will lose. That's a fact. It's sobering. It hurts. But buying individual stocks, you'll probably lose. And your financial planner who's buying individual stocks, he's probably going to lose too. Or like net of fees be the exact same as the benchmark, therefore not justifying his value, unless he's providing you value in other ways through like tax planning or something. In which case, then it makes sense. Charlie's Humane says add. I don't know what ad means. But Steve Jensen's, how did your road trip go to buy a business? We've gone on a couple road trips now to Toronto to buy businesses, looking at a few different interesting businesses. What I can say is very good. We are probably going, there's like a really, really 99% probability we're going to buy this business. We're probably going to buy like 3 businesses in the 5 to 10 million revenue range. So I'm hoping in the next 2 years to own about businesses that generate 25 million in revenue, profit probably 2 million. So that would be kind of cool to own. If I could own companies that aggregate bring in 100 million in revenue or a billion in revenue, that would be so cool. Like just own even a third or 25% of these companies that bring in such huge revenue. That'll get me in the door with the right people and start opening some opportunities up at the same time, especially with the banks. Because once you've got those, right now I have a hard time buying real estate because I don't have solid income. The banks don't like rental income. They like income from businesses. When you buy a business that has 3 years of financial statements, they can't tell when you bought that business. So you say, I own this business. Here's my business. It's bringing in 500,000 in income. That'll let you qualify. You can instantly qualify for buying property again. So I can use, as a financially independent person without a day job, I can use this business that has more than 2 years solid financials to qualify to buy real estate and buy other businesses. So once you get one big, solid, profitable business, you can use that to buy more businesses. So it opens up doors and the snowball starts. I want to start that snowball in the private equity space as well as the real estate space. That's how I'm going to get to 100 million net worth. I mean, that's going to happen no matter what if I just keep growing at 13%. But 13% CAGR equals 100 million net worth, like in my 50s or 60s. So totally, it sounds crazy to say that, and like, but just look at the math. It's totally possible. You just got to be diligent and save. You know, the reason people don't become multimillionaires is because they don't plant the seeds in the beginning. And then when they get to that luxury life, they go and buy that nice house and that nice car. I still drive that Ford Focus. Even though I'm a multimillionaire, it's a $2,500 car. I still have one car. We're a one-car family right now. You know, we still house hack. We still do all these things that people that have less than $1 million do. And I still, you know, we were at Qdoba the other day, and I was so tempted, and I regret not buying that food. Jonas, if you're watching, you know what I mean. I should have bought that bowl, but like that's like my mentality is still like save that $12 because I know that $12 is going to be $1,000, you know, 50 years from now, invested well. So that mentality has done well for me. Preval Kapoor says, greetings from Germany. Hey, greetings. I'm really hoping that if she's watching this, that the reporter who came down and stayed with me for 4 days in Canada a year ago almost, not quite a year ago, a bit less than a year ago, who did the article on the FIRE movement, publishes that in, it's Ditzite. I'm supposed to be published in that article with Vicki Robbins and some other really cool people. So I'm really excited for that article to eventually come out, if it ever does come out, because eventually it might get stale, I don't know. But I'm excited for that to come out, and you can check that article out. It'll be in German, so that'd be fun. E. McHugh says, there are multiple ways to earn returns with real estate, and most are within your sphere of influence. Yeah, your sphere of influence is so important. You have control over the asset class. That's the great thing about buying smaller private businesses versus stocks, or buying real estate instead of stocks. The nice thing about buying stocks are that you can sit on a beach and collect a check. If you own a rental portfolio, unless you have a really good manager, you're getting calls all the time from the tenants. You're getting calls from, you know, all the problems in that, right? You're managing everything. That's a lot of work. That's a job. You don't necessarily want that. That's semi-passive income. You might want that over a day job, but you won't want that. Once you're in that position, you won't want that over completely passive income. I can tell you that. Awesome advice. Thank you. I appreciate that. Hey, Mike, can you please analyze this property? Sure, I'll take a look. Happy to. I'm gonna jump down to the bottom, answer a couple questions, and then jump back up to that property, okay? Mike, please make sure that anything you buy is recession resistant. That's right. William's got a great point. Buying businesses, you need to be careful to buy recession resistant businesses, because in times of recession, if you buy a business that is very consumer goods focused, you can be hurt very hard. So you have to be careful, obviously, of that. Very, very good points. Live and Breathe Real Estate says, Mike, what are your thoughts about the inverted yield curve and upcoming recession? Check out this Saturday's video for some of my thoughts on that. I'm thinking that a lot of the recession fears are priced in now, because everyone knows about this inverted yield curve and knows the data. What we know is that it's very, like, historically speaking, when there's been an inverted yield curve where long-term returns are worse than short-term returns, rarely happens. Usually investors are incentivized to buy long-term, but when they aren't, then you're gonna have a problem, because no one wants to, basically no one wants to lend. my video is going to go into a bit more on that and talk about the Canadian real estate market and how I think it's going to impact things. But yeah, I do think a recession is possible. I don't know what catalyst is going to start it. I don't see a catalyst right now. It might be like consumer debt, might be part of the catalyst, but you still need a catalyst for the consumer debt to become a problem, right? As long as people are still working and making money and we're in a strong economy that we are right now, then it doesn't matter. People can keep paying their debt. Yeah, so good points. What do I think about it? I think it's a good opportunity. I'm excited for it. Okay, let's go up here and where was I at here? There's someone asked me to look at this property. Click. Terms of use. It's not letting me in. There we go. Okay. Someone sent me a link. Let's all jump on this link together and look at this property. Ooh, it's in Windsor, which I know hardly anything about. Awesome. 1651 Martindale, Windsor, Ontario. It's got a little video. Great value in this market with tons of investment potential. Townhouse style home, 2-bedroom, 1.5 bath, just blocks from the river and U of W, University of Windsor. Move-in ready, et cetera, et cetera. Updates, the roof, wiring, plumbing, clean home with plenty of space, move-in ready. This property does have gas, so it's not, I guess, electric baseboard heating. And with a home attached on each side, it will keep you insulated. That's actually true. My semis have insanely low cost of heating. My semis, they're like, for a long time when London was really expensive, in my opinion, I was buying semis. And I was buying in good areas like Northwest London. People were buying Old East Village. I was buying the same type properties, 1% rural properties in good areas. Or like most properties in Northwest London are like 0.5% rural. And I was buying 1% rural because I was buying semis. And I was converting these semis into duplexes. And because they're bungalow type semis where you can have a lower apartment and an upper apartment. And I bought like 3 of them on the same street. I loved that they shared a wall. My heating costs were like half because they shared a warm wall. And so basically, there's a number of savings. When you're finishing a basement, you don't have to insulate that shared wall. Like you don't need any thermal insulation. So you save like, at least a quarter. The way these buildings were built, it was like half the wall was shared. So like half of it is less insulation to finish it, etc. And you get the heat from the other unit, especially if you had a neighbor that kept it really hot, which my neighbors did. So that heat came over and kept my places that I kept relatively cool heated well. I had a property on that street. I think Wenlock for a while was like $40 a month when gas prices were lower. I was heating it for $38 a month equal billing at the low point. So that's an example of like $38 a month to heat a 5-bedroom, 2-bath duplex. That's pretty good. And it's like 1,000 square foot a level, 2,000 square feet of living space for $39 a month to heat that place. That's a huge thing. So I do love semis. I will say that much. Let's take a look. Looks kind of nice from the outside. Inside's got some older hardwood floors. Look a little beat up, but not too bad. I don't love the beige trim, but super easy to paint that trim white and clean it up. I do see electric baseboard. So it's interesting they said gas. Maybe it has gas capability, but not heated by gas. Electric baseboard heating means in the wintertime, you're gonna have like $500 hydro bills. I guess it is a semi on both sides, so you're not gonna have that high of bills, but 100,000 is cheap. Sounds like a good entry market property. Looks like it's in decent condition. Bathroom looks clean. Basement looks like it needs a renovation. It's not very clean. Tiny little backyard. Row houses. I think you're better off buying a detached home. I see them pop up for like 130, 140, 150,000. I think it's a better value than buying a row house like this. I don't know what this row house could rent for. Maybe $1,000 a month in Windsor. I don't know. It's kind of hard. It's only 2-bedroom. They look like they're small bedrooms. So in my opinion, it's not even a 1% rural property. Are there condo fees associated with this property? Are there some other things like maintenance fees or something? I don't know. It doesn't say on the listing. I scroll down here. Doesn't say. Overall, for me, this property would be a good little property maybe to buy if you're, maybe want to live in it. It's a low cost of living place to live. If you're going to buy as a rental property, you can do better in Windsor. I was looking at a property 2 months ago that was $199,000 in Windsor that had 8 bedrooms. That gives you a price point of, was 8 into 200. It's like $25,000 a bedroom. So $25,000 a bedroom is a benchmark you could use in Windsor, I think. So you could buy a 5-bedroom house for, No, you know what? It's not a great benchmark. It is a great benchmark if you're buying 7 and 8 bedroom houses. I think what you're seeing on the 5-bedroom and 4-bedroom houses is like 40,000 a bedroom. This place is 2 bedrooms for $100,000. It's 50,000 a bedroom in Windsor. You could get that in London. Man, I don't know if I like this property that much, to be honest with you. I have to look at comparables. Maybe there's one sold around here for like 120, and in which case you're getting a little bit of a discount. If it's at market, which I think it probably is, it's an okay property. Could be a good little property. If you wanted to live in a property, I would recommend a house hacking scenario. Maybe you have a best friend who you rent with right now, like what Kyle had, and this place is a great, you turn the basement into a little suite, and you can put it on Airbnb, and then you live in one of the rooms, and your buddy lives in one of the rooms, and then you make this little 2-bedroom plus basement. You make it work for you. It becomes like a 3-bed kind of little semi. You buy it for 100 grand. Maybe you offer 90 grand or something. It could work.
Does a room have to be a legal bedroom to be able to rent it out on Airbnb?
I don't think so. They say, well, yeah, the Airbnb says you have to comply, blah, blah, blah.
Right.
But you could just do it. Like I know people who just do stuff on Airbnb that isn't 100% compliant. There's no rental licenses in Windsor either. So no one's going to come and force anything anyway. I don't think.
Fair enough.
Worst case scenario, it's not that expensive to cut in an egress window. Like we're talking $1,500. $10,000, you got a nice finished basement down there. Nice little, with an egress window. Make it into like a bachelor down there. Really easy to do. That's a way you can kind of make this property work for you, as maybe a house hack, or even kind of make it cash flow. So that's how you do it. Like this video, like him. Charlie's Human, thank you, appreciate that. Yes, smash that like button, jump in the comments, and please share my videos that I drop every Saturday. It means a lot to me when they get a lot of views, and when you guys tune in and drop in the comments for that. The Wise Wealth Show, again, is something that I do every single week to provide value for you guys. So if you enjoy it, jump in the comments after and let me know. Keep doing your thing, Mike. We read that question. Do you use tangerine? So Hong Kong Fui says, do you use tangerine? So I don't use, no, we do use tangerine. My wife has an account at Tangerine. They lured us in with their like 2.7% interest on their savings accounts promotion. And they had another promotion where they gave us like some credit card bonus. They lured us in. I don't do primarily I don't do any of my primary banking there, but I do have bank accounts with Tangerine. They're not my primary bank, but for rental properties, Bank of Montreal is on point. You can have 20 individual checking accounts off of one lead account. The other 19 accounts, which are great for joint venture partnerships, you give the other partner a separate debit card for each one. All 20 are in one login when you log into your computer, and there's no monthly fee for the other 19 accounts. So if you keep $6,000 or $5,000 in your main checking account, the other 19 accounts can be free. BMO is amazing for that. It is the joint venture bank account company to work at. I don't know why guys use TD and other companies, because they have to pay for each bank account. BMO. Some videos with your mentees would be interesting. Yeah, we definitely talked about wanting to do that. Financial Investor says, what part of Germany? I don't see him popping on to answer that, but maybe we'll catch it later. Just popping on to say hi, I'll check the replay. Thanks, Brandon. Appreciate that. Brian Larson, if you do at Mike Rosehart, it means it's easier to see for him. I know lots of guys stream and miss questions. Yes, this is true. At Mike Rosehart does help me catch it a little bit quicker. It's a good point. Fankin says, I'm an hour outside of Vancouver and my place is $1 million. I wonder about selling. My gut feeling is there's something big recession-wise coming. What a guy has to still live somewhere, right? Yeah, good point. You got to live somewhere, but imagine your $1 million house. Now in your area, if you could sell your house for $1 million, take that $1 million and invest it at say 8%, which is the S&P 500 type return. That's $80,000 a year in return. $80,000 a year in growth. So you'll make $80,000 a year by selling your house. I can guarantee you can rent the exact same house you live in now for less than $80,000 a year. Would you buy your house right now for its current market value? If the answer is no, you should probably sell it, especially if it's your primary residence, because there's no tax consequences. It's tax-free. So I'm a big fan of just finding a lease and renting. And a market like Vancouver or Toronto, like if I end up having to be in Toronto for my businesses a few days a week and we have to rent a place, or I have to stay a place, I kind of just, there's a little Freudian slip. If we have to stay a place in Toronto, I would rent a place. Renting is way more cost effective than owning. The only thing with owning is an emotional, I guess it's really nice emotionally. So hopefully I answered your question. I'm going to close this tab now about 1651 Martindale. You could make it work if you converted the basement and sort of Airbnb'd that, maybe lived in the top and then had a friend live in the other room. Could definitely make that work. You could pay the mortgage relatively easily by making the basement into an Airbnb suite. So there are plays that could also work for you. Is it the best deal in the market in Windsor? I don't think so. I think a real estate agent could find you a better property. It would still work for you though. And that said, there's nothing wrong with buying that property. It might work for you perfectly. What up, Mike? Finally made a live stream. Been a while. What is your opinion on the 3-tiered corporate structure? I'm predicting to have $6K cash flow. Would it be advised for me to look into it? Don Trent, no, I don't think the 3-tiered corporate structure makes sense at $6K a month cash flow. I think you need depends on the personal side. Like Don, if you're making $150,000 a year, then you're already at the max tax bracket personally. So then you get an advantage owning in the 3-tiered corporate structure and pulling the money into an active property management corp. Could make some sense. But remember, you have to file 3 corporate tax returns, 3 shareholders meetings, there's administrative costs, there's accounting costs, there's also costs to set up the corp. So you're talking like $5,000, $10,000 a year in fees. So you have to ask yourself, will I save in taxes more than $10,000? If the answer is you're gonna save $10,000 and you're gonna cost $10,000 in fees, the headaches aren't worth it in my opinion. So I would just say no. But if you have a big enough portfolio, it makes sense. We now have corporations that we hold our ownerships in. Yeah. Smash the like button. The Snowball is a great read. Yeah, I haven't actually read that book. So send it to me. I've done a video on the real estate snowball, but it's just kind of me discovering that in the wild. Adventures on Vancouver Island says, I'm single and I own a house. What are your thoughts on living in the garage and renting the main part of the house? I can shower, etc. at work or at the gym. I get $2,500 a month and I'm in Victoria. My actual advice is if it's your primary residence, sell it. Take the cash-free gains and run and rent a place. Rent out a flat. They have a lot of those garage flats in Vancouver. When I was there last time, ton of them. They call them lane houses, I think. They're great. You have ones that have full kitchens, full bathrooms. You rent them relatively cheap for like $1,200 a month. You take the $1 million, you take the $2 million, whatever your house is worth, you invest that at 7-8%, safe. You invest it, you can invest in real estate investors that'll pay you 10 and 12 or higher. And you use that to pay for your rent and you still have money left over. That's my thought. I would rent if I was in Vancouver. But yes, if you wanted to keep that property and selling was not an option, yeah, you can convert your garage into a lane house and rent the main house out. Definitely. Or do the opposite, live in the main house and rent the lane house out. Future Wiz says, perks of being single. Financial investor, yeah, borrow is better than having them in deal. Yep. Snake Eyes 11 says, when you say 25% ROI, are you talking about principal and cash flow, or does that include appreciation too? I don't include appreciation in that 25%. Appreciation is a bonus on top of that. Added ventures, you can't do that when you got a family weighing you down. Very true. Very true. There are disadvantages. I still house hack, and my second's gonna be born in like 2 months. My wife's like 7 months pregnant right now. So, and we still house hack. I've got a whole like 3-bedroom, nanny suite going on, and it's generating a ton of cash flow, plus a den, so like 4 rooms. And I live in a nice big house in a great neighborhood. My daughter doesn't have to feel like you get shot or stabbed at night, like living in a multi-family kind of area. We live in like pretty much a primarily single family area, and we just happen to convert our property in such a way that it has a nanny suite. And that can pair whole mortgage. So you can still do that with a nice big house. I eventually will upgrade to a castle or a mansion. It's gonna happen, it's a goal of mine, even for like a year or two just to try it and probably sell it for more than I bought it for by adding some value in some way or buying a property that's way below market value, like my friend John Kepler's done and Alicia. So something like that. And I would house hack it though. I would rent out portions of it to cover the cost because I just can't see myself using a whole mansion or a castle. So you can even do it with big houses. You can house hack. It doesn't have to be in bad areas with large multifamily. Thankin says, how would that 10% be guaranteed? Lender's name would be on title of property or secured against another property? Yeah, good question. Haven't thought about really. I guess if I was to do it in an ideal structure for me, would be the investor gets a second secured position. So actually even better would be the investor buys the property. They're on title. And we have an option to buy the property from them at said price. And basically, they own the property. They feel safe owning it. They get the mortgage on it. We guarantee them their 10%. We manage the property for them, collect the rent. We guarantee them the 10%, and we split the appreciation or something like 50-50. That would be a scenario where we don't have to worry about calculating all of the all the rental income. There'll be no months where there's vacancies or anything. We just pay 10% guaranteed, and people feel safe. The other option is, again, just securing the down payment in the second secured position and giving them 10% guaranteed. I have to think about how to get creative to structure it, but there are definitely some ways you could structure it where you would own the property and feel safe knowing that you're on title if anything happens, but have agreements set aside where basically you're getting like a 10% guaranteed return. So there are ways to do it and set it up. Could just lend the money again against the company and put a first secured bank mortgage and then take the investor's capital and put it in second secured position for like the down payment of sorts, and then give a guaranteed 10% rate of return plus 50% of appreciation or something like that. Any advice on calculating debt ratios, GDS, TDS with multiple properties, playing with some math, trying to figure out a couple of scenarios? Yeah, so what I've found is the banks typically, when they're calculating your TDS or your GDS, they will use between 50 and 70% of rental income in that calculation. And they'll take like low heat, you can give them like property taxes and rent, and they'll take that in there and minus off like the mortgage interest, property taxes and rent, and heat. Sometimes utilities like electricity as well. But you can give them low figures like $50 a month for heat, and they'll just accept that at face value. And yeah, I've seen like a lot of the bigger banks are at 50% of rent. So it makes it hard to qualify with just rental income. And the banks don't like if you don't have a day job. They don't like you to just have rental properties. They find that really risky. I don't know why. In my mind, it'd be like, okay, you're full-time landlord, professional landlord, it'd be less risky. But they just feel safer with someone having a job. Just why buying businesses can help you qualify for real estate properties if you're financially independent. But yeah, any advice? Basically just use like 50% of rent to be conservative. Credit unions will use 70, 75%, some of them. Hey Mike, how long before you think after your first mortgage, your bank will give you a second mortgage and you can avoid investor loan interest rates? You can do it right away. You could buy it, like my third to fourth or fifth, sixth property, I was buying like every 3-6 months, banks are gonna be mortgages. If you can qualify right away, do it. As soon as you have the property rented out, you bring the bank a lease, you show them you have a lease, and you can go buy another property. In fact, if the rental income is really strong on that rental property, MeZZ, it'll help you buy the next property, actually make your ratios better in some situations. When I was buying like 1.5% rural properties in London, Ontario that rented really strongly based on value, they were actually adding. If you're buying houses in Vancouver or Toronto, it'll slow you down because the rent doesn't service the mortgage and all that stuff at 50% of rents included. In London, it does if you're buying cash flow. So in Windsor, other markets, it does. So it depends on the property. It can get easier to buy properties when you're buying more of them. It can actually be faster. There is no necessarily time period though. It's just if you qualify based on your income and expenses for the amount you want to borrow, you can buy another property. They do get to a number like 5 or 10 where it kind of runs out. Peps22 says, do you have personal coaching? I don't do any personal coaching. People have asked me to do personal coaching. I've kind of shied away from it just because I'm so busy. Technically, it says I'll do coaching for $99 an hour on the phone for an hour. I'm just so busy that like I haven't had time to do that. You can email me and maybe we'll set something up. More likely than not, I'll be too busy. Join me for the Buy-Sell show and we'll do it for free. Some of my investors get some personal coaching. That's a benefit of investing with me, I guess. Mike, curious if you watched Concrete on YouTube. I love Concrete, specifically Ben Mala's Life for Sale. I think it's very interesting if you ever consider doing business in the States. He made a fortune off 1031s and renos, TY. Yeah, we saw Graham had him on his channel. Bob was watching him before he was on Graham's channel. And Ben Mala has like $250 million real estate portfolio. And it's all because he was buying properties, fixing them up, and then 1031 exchanging. Canada doesn't have a 1031 exchange. It's a real shame. All we've got is the primary residence tax exemption. So you can buy a house for 500, sell it for 700, make 200,000, upscale to the next one from 700 to 900,000, etc., and do that with your primary residences and do all that tax free. That's about it. We have to pay tax every time we sell a property. That's why refining a property can make more sense than selling it in some situations because the tax consequences here in Canada. It's a bummer. That's why I'm going to start getting into real estate in the US at some point because truthfully and honestly, the 1031 exchange is OP. It is overpowered to not have to pay any tax when you sell a property and just roll that profit into the next property. You go from a $200,000 house to a $10 million property and just keep delaying paying the tax. Huge, amazing. Yeah. You can do it within a corp here in Canada. You can a small small business corp in Canada pays 13.5% tax on the first $500,000 in earnings. So you could theoretically shelter a lot of stuff paying 13.5% tax. If you were flipping in a corp, paying 13.5% tax. Something to think about. Live and breathe real estate. How's it going? E. McHugh says we stay focused on a couple markets in the Northeast here in the States. Things slow down dramatically in the winter. Same as ourselves here. Things slow down a lot when people go away for holidays. In the winter, no one wants to look at properties. Same thing. We're often the only folks looking in February, and often folks are ready to sell. You're right. Exactly. Lowered supply because no one wants to list their house in the winter. And houses sell for like 10% less because they're not landscaped well. It's the winter. It's cold. There's not as many buyers, etc. Compared to the heat of the spring. Very common in seasonal markets. Definitely. Best time to buy is in the fall and in the winter. What about buying stocks like Visa, MasterCard, Sherwin-Williams, Microsoft, big blue chip comps? Yeah, I mean, you could make your own portfolio, but why not just buy into an ETF that owns small portions of all of those companies and will automatically rebalance their portfolio for you? I mean, it's just easier and simpler, and you get the same sort of return with better diversification. I'd rather own a small percentage of every single blue chip through an ETF, like an index type fund, than buy all of those individually and have to rebalance them all the time. You get the same net effect. It's just easier to buy the ETF. Are you Christian? Yes, I was raised Catholic, went to a Catholic high school and elementary school. Live and breathe real estate. I'm still driving my same Honda as well, trying to live that frugal life. That's right. You know what's up. Okay. I got a lot of questions to get through here. Mike, please make sure that we've read that question already. We talked about the inverted yield curve. Do you ever go to greaterfool.ca? It's a daily blog focused on Canadian investments and politics. Pretty entertaining read. Comment section is pretty funny too. No, I don't. I've heard the website, but I don't go there. Maybe I should. It's just I wake up in the morning and I literally have like texts from contractors, my team of employees, and tenants and stuff. Mostly not tenants anymore, but a lot of like contractor stuff. And I just, first hour, I just respond to DMs on Instagram and text messages and Facebook messages and stuff. So that's what I do in my first hour or two. I wish I had more time in the day. Honestly, I don't feel like I have any time to read entertaining stuff, but maybe I will in the future. You are a champ, dude. Thanks, appreciate it. Hot tip for college towns. Reach out to the HR at the college. They're always looking for housing options for visiting and full-time staff and faculty, typically strong tenants. Yeah, good point. They have actually, like in my university, an actual website. You have to pay to advertise on there, and that's like their housing website that has all the like the student rentals on there, and you pay like $20 to get on there, and they do have good quality students on there, and that's where the university pushes everyone to, is that website. It's a fair way to get all the landlords on there. So unfortunately, you can't get like ahead without paying, unfortunately. Financial Investor says, so it's turnkey, no equity there. Hey Mike, do you ever watch Stefan Arnio on YouTube? No. No, I don't really watch Stefan Arnio on YouTube. Stefan Arnio and I used to have a little beef like 2 years ago. We'd have like some big Facebook like debates back and forth. He fundamentally is he's changed a lot. He has a lot of really good content. I like his books. I like a lot of his content. I think he and I have different personalities, put it that way.
That's
where
an understatement.
where he might be okay selling snake oil to his best friend to choke on, I ethically would take a loss to avoid selling a product like that. So ethically, and morally, we are totally different. I think fundamentally speaking, from a knowledge standpoint, we agree on a lot of the same terms. And he's come around, in the real estate world, we share a lot of the same, he's a good real estate investor, and his content is on point, his coaching is overvalued, and his moral compass doesn't align with mine. That's all there is for me, and don't sue me, Stefan, because I'm sure we're going to be on the same panel at ORAC at some point. I know Matt's going to do that to me. Like, I just know it.
So Arnio's going to be there.
That's going to be fun.
I find him interesting.
He was like the anti-me for a long time. Like everything I stood for, he stood for the opposite. Except for like from a real estate fundamental perspective, we agree on the same fundamentals because they are what they are, the math's math. Yeah. But like where he could like pillage someone for 20 cents on the dollar and like do it to his own parents, I have too much moral compass for that. I think the guy knows his stuff. He's way too salesy for me. So I just don't enjoy his stuff that much.
Sure. I can see that.
But I mean, his books are great. I've read some of his books and there's some good stuff there. Andrew, how you doing? Good to see you on. Praven retracted his message. I'm not sure what he said. Fankin says, yeah, but S&P will obviously be going down too, though. Yes, it could go down. But let's just think in a 5-year time horizon, right? Even if the market crashes like it did in 2008, one of the biggest recessions we've ever had, even in the dirty 30s, the dirty 30s, the recession, the Great Depression, everything was recovered within 8 years. Within a 10-year cycle, if you just hold the S&P 500, you will win. If you just hold it for 20 years, you'll make 8% a year. You'll have years where you're down. If you don't sell and you hold, you'll be up way more than you were when you started. So that's something to think about. Can't really lose if you got a long time horizon. What's your favorite color? There we go. Now we're asking some random questions. Blue. Favorite color is blue. How to save. Wow, I caught it. Awesome. Good to see you on How to Save. JT says, hey, Mike, can you explain how collateral mortgage works like a line of credit? So collateral charge mortgage is basically just the idea that the bank registers on the property for more than the value of the property. So you buy a $300,000 property, they register a $400,000 mortgage. The reason a collateral charge mortgage is great is because you can go back to the bank without any re-registering on title. They can go issue a bigger mortgage. They can discharge your old mortgage and put a new mortgage on for a bigger amount. So you can go from if you had a mortgage on it for $250, you go back and refinance it, you can put a mortgage on it for $350 without paying a lawyer to take the mortgage off and put it back on and pay all these fees. Just saves you the legal cost of doing all that. Makes it a way simpler process. It's pre-registered, so the mortgage you have doesn't have to be fully removed and put back on. You can just basically go for a higher amount of mortgage debt. It's basically how it works in a nutshell. That wasn't a great explanation, but that's the nuts and bolts of it. I gotta go quick here because it's bath time. So I'm gonna power through these next bit of questions. Do you recommend putting less than 20% down in the US? How to save? Yes, I do in the US because the PMI, private mortgage insurance, is cheap in the US. And as soon as you get over 20% equity by paying down the debt or adding value in some way, the PMI disappears. It's like a monthly payment for as long as you need it. In Canada, it's an upfront fee. You should never buy less than 20%. The math does not work ever. And any person who says CMHC is good is mostly saying it because they don't understand, or because they did it themselves and they're going through some cognitive dissonance. The math does not work. I will argue with any person on that. CMHC is terrible. They take 4% of your down payment, gone. You put 5% down, you lose your 5% down payment. That's disgusting. And the value that provides you putting 5% down is gone within 2 years in 99% of situations, because mortgage pay down, you basically get to a point where you're 20% down on the property anyway. So the value it provides you is for a short-term period, and you take 5% of your down payment to give you a short-term benefit. It's not that great. There are better ways. Go borrow the capital, the remaining 15% you need to be 20% down from a loan shark at 15%. It's cheaper, straight up. If you're gonna BRRRR or refinance anyway, don't do 5% down especially. There's a couple scenarios where this 5% CMHC works, and we can talk about those scenarios another time because I'm running out of time. We house hack, live in rehab with a 5 and a 7-year-old. There you go. I mean, I'm going through renovation all the time, even right now. You guys can hear it in the background probably. Living through renovations sucks, but it's what we do to get ahead sometimes. So good for you guys. Cassie's house hacking with one on the way. Hey, congratulations. I didn't know you had one on the way. Good for you guys. Congrats. Nice at Preval Kapur. I've been there before. I was in Heidelberg for many years. Great place to visit and travel around. Cool. Yeah, I got to get to Europe. With this new company we're buying, I might be doing some trips to Europe and some trips to China, so that'll be interesting. Really excited to share the videos when I go and travel to China and some of the places with that business. So.
Be very careful what you film/take pictures of.
Yes, this is true. This is true. It might be like me in my hotel room just talking about it. Like that's pretty much it when I get back. This is true. This is true. Don't film anything while I'm there, right?
It's so dangerous.
What's going on, Mike? Hey, brother. Have you ever tried to do a rent to own on a condo or property in order to get more cap rate by eliminating maintenance fees such as property manager, etc.? Will Gonzalez, yeah, the rent to own, in my experience, I've seen guys doing it. It's so savage. Most of the rent to own guys take advantage of the person they're putting in to do the rent to own. They almost always have the intention of not ever completing the rent to own. They want the person to fall through and they take the deposit. And the contracts are worded very greedily for the guy who sets up the rent to own. They get paid really well and the investor doesn't get paid that well. And the tenant or rent to own candidate who wants to own it, they get screwed. The only person that really wins is the guy setting them up. So ethically, they don't agree with my moral compass. I've seen some people do them okay. There are a few individuals I've seen do rent to owns cleanly and fairly, with the actual intention of, you got to really coach the tenant through the time to help them improve their credit score and all these things to get them to a point where they can actually close on the house and buy it. So no, I've not done any rent to owns. I understand the process. I've talked to guys and seen the contracts, understand how it works. I've just never had a situation where it's made sense for us. Matt McClure says, how much is good monthly cash flow? What is good monthly cash flow? I think, in my opinion, Matt, $1,000 a month per property makes a lot of sense. I look for 25% cash on cash is roughly, so depending on the price of the property, you get more. So if you put $100,000 down, you should expect about $2,000 a month in profit. But $50,000 down payment, you should expect about $1,000 a month in profit. That means that no house in Toronto or Vancouver qualifies, unfortunately. That's sort of what I'm looking for. That's my benchmark. So between $1,000 and $2,000 a month in net profit. Cassie says, at Mike Rosehart, would you include expenses on a current rental in that as well? The mortgage on a current property. So I think, are you talking about the total debt service ratios? So on total debt service ratio, Cassie, the big thing is they're going to take about 50% of rents, and they're going to take mortgage interest and your like heat and utilities. That's what they're going to use. Yeah. Financial investor says 200 to 300 plus after all expenses is what I aim for. Financial investor, that's super low. I'm looking for double or triple that in most cases. Depends how you calculate cash flow though. Some people use bad debt expense ratios that are high. Some people use vacancy rates that are very high. So it depends on what rate you use for your bad debt and your vacancy. Fankin says, what is your educational background? I went to University of Western Ontario, and I went to the Richard Ivey School of Business, where I took a degree in finance and basically finance economics and entrepreneurial finance being a focus, as well as accounting. I worked at KPMG and did a stint there, focusing towards my CPA. Went away from that and went into consulting. I worked 3 years as an analyst. They promoted me as senior analyst, and then as a manager doing business consulting for leadership in IT. So focused on IT development. And then I was doing real estate the whole time. So that's sort of my background. It's left me in a position where I'm poised very well to do well in buying businesses and flipping them. And it's what I enjoy, actually. And I grew up poor. So my background is I grew up with not a lot. Hey, Mike, love your channel. Sardino, thank you. Appreciate that so much. Time, energy, or money equals passive income. So true. That's right. The last video I talked about that. It's at the end of the day, you've got to invest time or you got to invest money if you want passive income. A lot of people want that passive income right now. They got no money and they don't want to put any time in. They don't want to put any energy in. They don't want to put any effort in. You want that passive income, you got to build a product to sell. You got to build a business. You got to renovate a property. You got to, even YouTube, people talking about passive income from YouTube. It's not really a great source. You got to put out 1,000 videos. Or like 100 really good videos. It's going to take you thousands of hours before you start even generating 1,000 or 2,000 in passive income. The dollar per hour is terrible on YouTube. Like guys who just outsource their entire YouTube channel and don't do it as a hobby or a passion, like the guys who literally just outsource everything, those people lose thousands of dollars and they never make it back. So it's not it really just isn't a good job. YouTube's a terrible job. But if you want to give back, which has been my mission, it makes a lot of good sense. And if you have something to share and you continue to throw value out there, I think eventually you will generate some income. And at some point, like you get to the Graham Stephan level and his dollars per hour are hundreds of dollars per hour for every video he makes. Now, if you average all the time he spent in total, because that guy responds to every comment, I'm sure he's still like minimum wage because he spent a lot of time working on his channel over the last couple of years.
Unless you're like PewDiePie level or something.
Yeah, and in which case, yeah, if you get to the ultimate level, you win the lottery of like fame and popularity, then you start making big money. But you had to put in a lot of time and energy to get there. Yeah. And remember, like 1% of people get to that level. 99% of people follow the exact same steps and don't get those results. Yeah. So I'm not going to share that as a really good source of passive income. I think like real estate is like you follow these steps, you get the result. You follow the same steps in YouTube, and you might not get the results. Like you just won't.
You have to hit it big.
That's right.
And or produce content that requires a minimum amount of
Yeah,
effort.
yeah.
Like
and I think eventually we're going to get there. Like I've been throwing out, consistency is key too with YouTube. People fall off and get back on. That's a bad strategy. I go live every single Wednesday between 7 and 7:15 p.m. Eastern Standard Time. Every single Wednesday, right? When I'm on vacation, no matter what. And we're going to drop a video every single Saturday. We will never miss a video at noon Eastern. The reason we do that is because you guys are expecting that content. You You get to fall in love with the character and fall in love with the content, the education, and that's how you build a real brand in a channel. I think just throwing the video off here and there isn't a great way to do it. I don't know why we got down this tangent about YouTube. I don't know how we got here, but
The passive income thing.
yeah, that's right. Kyle says hit that like button. Appreciate that, guys. That'd mean a lot. Got to catch the replay. Good to see you on. Austin, FI, yeah. So you're AY2. He's a mentee. Justin Golf says, hey, Mike, what is your take on East Coast real estate? I don't hear too many people talking about it. Justin, I was actually in Newfoundland not so long ago. And my experience in Newfoundland was the buildings are all different than they are here. It's really interesting in that sense. And the climate's different there. It looked more depressed to me. The economy seemed weaker. It seemed like the unemployment's higher. So the economy isn't as strong. So I'd expect a higher return than I get in my market in like southwestern Ontario, right? In more central province. Out east, I think there's a ton of potential. I met some guys out there who are crushing in real estate. So there are opportunities out there to make a lot of money. The cap rates can be very good. The same principles apply. You gotta be buying the right cash flowing properties. I think there is a play there. The market is depressed. I think that it could be worse if we go into a bit of a recession. That said, if you're buying for cash flow and you're making $1,000 a month cash flow on your property, do you care if the price of the property falls? Because in 10 years, it's going to be back up again. We know that real estate does this, right? It looks like the trend line looks like that. It's moving in one direction up. There may be over a 3-year period where you bought at a high and you're in a low where you're actually below, but over a 10-year period, you can't lose. So long term, buy and hold, you win in real estate. 5% down works well. Canada says 5% down works well. It does not work well in Canada. CMHC fees are dirty. They destroy your capital. But I guess if it gets you in and you couldn't borrow the money any other way, I would argue go on Kijiji and go ask some loan sharks for some money. There are guys who will loan for real estate for like 10%. There are guys who just do private lending. That's their only thing. They lend for real estate at 10%. All right, I'm wrapping up, hon. Thanks, Mike. Appreciate your time. Have a good night. Thanks. Appreciate it. And for like the bunch of people that tuned in, like the 25 consistent people that tune in every single week, thank you so much for you guys. Appreciate it. Yeah, Chris Crone talks about rent to own, so tenant takes care of property better, but in the end, they fail the terms to buy and they end up being screwed. Exactly true. It can be very lucrative for the investor if you're setting up your own rent to own. If you're hiring someone else to set up your rent to own pool, and then you're just the investor, that's not so great of a strategy. It can be, it just depends. Noel says, hey Mike, had to drop a quick line. Good to see you on. I see you in ORAC, Ontario Real Estate Conference 2019 in like 2 weeks, so that's awesome. Check that out. And I look forward to connecting. For all those guys who are coming out to ORAC in London, come up to me. I want you guys to find me at the conference and come up to me and say, hey Mike, I love your YouTube channel. And just, we'll have a chat. Maybe we'll go out for lunch. Maybe we'll go for dinner after ORAC or during ORAC.
Yeah.
I know, I gotta hurry. I'm hurrying.
And if you don't have your ticket yet, use coupon code HARK. So
Use coupon code FIRE. That's my coupon code. FIRE. But if you actually know someone who's going, you can get 25% off. Using, yeah, instead of 20% off, you get 25% off. If you know someone who's going, they can buy it, they can bring a friend for 25% off. So that's another option as well. For the frugal people out there, look at that frugal discount. Hi, hey guys, where's Austin? You're so underrated. Austin's almost always on, but I guess Austin has a bit more access to me as he's joining the mentee program. So it's going to be Jonas, Michael, Antonio, and Austin in the mentee program. Kyle, sort of a mentee as well, ish. Wei was a mentee, now he's graduated and he's a business partner. I think all the people in the mentee program who make it through like the year or two, they have my undying loyalty, and when I'm a billionaire, they will all be taken care of. That's one thing I can promise. And they're all going to get a property, all of them. Every one of the mentees gets a property. We find a way, we make it work. You should go or you'll get in trouble, Mike. Right here. There he is. He's there, there's no questions today. All right, guys, I have to go. Gotta do bath time. Family is so important, guys. And check out this Saturday, we're dropping a video on Canadian real estate investing. So that one will be kind of cool, talking about the Canadian real estate market actually and some trends and where I think things are going. Yeah, thank you all for watching so much. Appreciate it. And see you guys in the comments. Share these videos around. Let's help this channel blow up. We're closing on 10,000 subs, and one lucky person who comments, the more you comment, the more chances you have to enter. You have to like the video, like into all my videos, like and comment on any of my videos, and one of my videos is going to be chosen at random. And then from there, one comment on that video is going to be chosen at random, and that person gets to have a free call with me and or a free day where we get a chance to kind of hang out and come down to London and check it out. So it's kind of up to you. You want to do the call or the day, depending how close you live geographically. So someone gets to win. And it might even, like, it'd be so crappy if it was like a mentee or something just by chance that won. But they get a day with me. Whoever wins, I'm making no favorites. I'm picking no favorites. Comment as much as you want.
I would say mentee's exempt, but
I almost should. I'll think about that. But yeah,
they live with you. So
it's true. It's true. But someone's gonna get chosen at random from my videos. I don't want to disincentivize anyone from commenting. I want the mentees to comment too on the videos. But comment on all the videos, and one video at random, one person's gonna be chosen and gets to win. So I'll see you guys all on the flip side. I'll see you on Saturday. I'll be in the comments. When I drop a video for the first couple hours, I'm always in the comments. So if you want to get hold of me, that's a good way. Or at Mike Rosehart on Instagram. See you guys. Oh, my catchphrase that I almost forgot because I've said it like 150 videos now, every single time. The secret to unlocking a wealth for you is to spend less, earn more, and maximize returns. In that order, and then as you build wealth, maximize returns, earn more, and then spend less being least important. But in the beginning of your journey, spend less, earn more, maximize returns. There's only 3 levers to play with, guys. A lot of people want to crank just one lever. I encourage you to crank all 3 levers. Right? That's what it is. Good night, guys. Good night. Thank you all for watching, and I'll see you in the comments. And I'll see you next week on the Wise Wealth Show, live, 7 p.m. Eastern, 7 to 7:15 p.m. Eastern, for the Wise Wealth Show every single Wednesday. Bye, guys. Oh, one push-up. I'm just gonna do it on the couch because like I want to break something. Last week I did like 75, so.
yeah.
All right, you get 3. I'm in like a suit jacket, so. Bye, guys.
You get 3 this week.
Go watch last week's if you want to see like 75 push-ups.